What if the most important sentence a central banker said this week wasn't the one that made the headlines, but the one sitting quietly underneath it? Gold and silver just did something that almost nobody expected after the quarter they'd both been through. Gold is trading back above $4,100 an ounce, clawing up off an 8-month low. Silver has pushed back above $61, recovering from its weakest levels since last November. Both moves happened inside about 48 hours, and both of them trace back to two events that most casual observers watched separately, without ever realizing they were part of the same story. One of those events was a stage in Portugal. The other was a number released early Thursday morning from Washington. Together, they tell you something about where this market may be heading that neither one tells you alone. Before we go further, I want to ask you something. Are you someone who's already holding physical gold or silver right now, riding out this correction? Or are you still standing on the sidelines waiting for a cleaner entry point? Drop a comment and let me know, and tell me where in the world you're watching this from, because the way this market is behaving right now looks very different depending on which side of that question you're on. Let's start with Portugal, because that's where this week's story actually begins. Every summer, the European Central Bank hosts a forum in the small coastal town of Sintra, and every summer, the world's most powerful central bankers show up to sit on a stage together and say things that move markets. This year was different for one specific reason. It was the first time Federal Reserve Chair Kevin Warsh appeared on that stage since taking over the Fed in May. Markets had been waiting for this moment for weeks, because Warsh's very first press conference back in mid-June had rattled investors. At that meeting, the Fed held rates steady in a range of 3.5% to 3.75%, but Warsh's tone was firm enough that traders pushed the odds of a rate hike by September above 60%. So when he walked onto that stage in Sintra alongside European Central Bank President Christine Lagarde, Bank of England Governor Andrew Bailey, and Bank of Canada Governor Tiff Macklem, the financial world leaned in, waiting for him to either confirm that hawkish path or walk it back. Here's what actually happened. Warsh did confirm that inflation remains too high in his view, and he reiterated that price stability is the Fed's core mission. That part made the headlines because it sounded exactly like more of the same tough talk from June. But sitting right next to that statement, almost buried underneath it, Warsh said something that changed the texture of the whole message. He acknowledged that inflation expectations have eased over the past month. He talked about growing open-mindedness among central bankers regarding artificial intelligence and its potential to ease price pressures through productivity gains, rather than assuming the Fed would need to fight inflation with rate hikes alone. And on the specific question of what happens at the Fed's next meeting in late July, he declined to give any hint at all. That combination matters more than either half of it does on its own. A hawk who says nothing but inflation is too high is predictable. A chairman who says inflation is too high, but also says expectations are easing and technology could help do some of the work, is telling you he's leaving himself room to maneuver. But here's the part almost nobody covering this story actually connected. It wasn't just Warsh saying this. Sitting on that same panel, Lagarde, Bailey, and Warsh all arrived at a shared conclusion about something that has quietly shaped monetary policy for over a decade. They agreed that forward guidance, the old practice of central banks telegraphing their next move months in advance, has essentially run its course. For years, this was considered essential communication. Central banks would hint at future rate paths to calm markets and guide long-term borrowing costs. The problem, as Lagarde put it during the discussion, is that a promised path becomes a trap the moment reality shifts, which is exactly what happened across the world in 2021 and 2022, when inflation arrived faster than every model had predicted. What Sintra 2026 confirmed is that 4 of the most powerful central bankers on Earth have now formally moved away from that model. They are choosing to stay data-dependent and unpredictable on purpose. For a market that has spent years pricing assets partly off of what central bankers say they're going to do next, that is a genuinely different operating environment, and it's one silver and gold holders should be tracking closely going forward. It's worth remembering just how different this tone was from where Warsh started as chair. When he first took over in late May, he had actually been seen as a relatively dovish pick, someone who had publicly called for lower rates in the lead-up to his own nomination. Once he was actually sitting in the chair, though, that posture shifted noticeably. His first press conference in mid-June leaned hawkish enough that it briefly rattled equity markets and pushed rate hike expectations higher. Sintra was the first time since that meeting that Warsh had to explain himself on an international stage, in front of the very central bankers whose own credibility depends on reading the Fed correctly. The fact that he chose that moment to soften his language, even slightly, rather than double down, is itself a piece of information worth sitting with. Now here's the question that actually determines what happens to your silver and gold holdings over the next several weeks. Does the labor market confirm what Warsh's tone in Sintra suggested, or does it undercut it? That question got answered faster than almost anyone expected. The Labor Department released the June jobs report on Thursday morning, and it landed well below what Wall Street was bracing for. The economy added just 57,000 jobs in June, compared with a consensus forecast sitting somewhere between 110 and 115,000. That's not a minor miss. It's one of the softest single-month prints in roughly a year, and it came alongside a downward revision to May's number, which now sits at 129,000, rather than the 172,000 originally reported. The unemployment rate actually ticked down to 4.2%, but that drop came for a reason that isn't particularly reassuring. It happened because the labor force participation rate fell to 61.5%, the lowest level since March of 2021, meaning fewer people were actively working or looking for work, not that more people found jobs. Leisure and hospitality alone shed 61,000 positions, even with a boost from World Cup-related tourism that many economists had expected to lift the numbers. Markets read this report almost instantly, and the reaction tells you everything about how fragile the hawkish narrative had become. Within minutes of the release, traders began scaling back their bets on a September rate hike, which had been sitting near 64% probability going into the report. Gold, which had spent all of June grinding lower through its worst quarterly decline since 2013, jumped back above $4,100. Silver climbed back above $61 an ounce, its strongest levels in weeks. Treasury yields fell as bond traders priced in a Fed that now has meaningfully less pressure to tighten policy in the near term. What you're watching here is the market doing exactly what Warsh's careful, hedged language in Sintra set it up to do. He didn't promise anything. He simply left the door open for a softer read, and the very next major data point walked straight through that door. Now here's where the story becomes more interesting, and where I think most of the coverage of this week's move has been getting it wrong. There's a temptation to treat this entire narrative as if it's purely about interest rates, purely about what the Fed does or doesn't do next. If you only follow that thread, you'll spend the next several months whipsawed by every speech, every data print, every rumor out of Washington, because that's genuinely how the monetary side of this market behaves right now. It moves fast, it moves on headlines, and it can reverse itself in a single session. But underneath that fast-moving monetary layer, there's a second, much slower story running in silver specifically, and it operates on a completely different timeline. Understanding both of these forces, and understanding that they're not the same clock, is probably the single most useful thing you can take away from this video. The fast layer is simple enough to explain. When traders expect the Fed to raise rates, the dollar tends to strengthen, and yields on safe assets like treasuries become more attractive. Silver and gold pay you nothing just for holding them, so every basis point added to expected returns elsewhere raises what economists call the opportunity cost of owning metal instead. That's the mechanism that pushed both metals lower through most of the second quarter, and it's the same mechanism that just reversed course after Thursday's jobs data. This layer will keep moving with every Fed speech, every inflation print, and every jobs report between now and the July 28th and 29th FOMC meeting, and probably well beyond it. The slower layer is structural, and it has almost nothing to do with what any central banker says on any given Wednesday. This is the story of silver's physical market, and the numbers behind it are, frankly, some of the starkest in the entire commodities complex right now. According to the Silver Institute's most recent World Silver Survey, produced together with the research firm Metals Focus, the global silver market is on track for its sixth consecutive year of a supply deficit in 2026, with the shortfall projected at 46.3 million ounces, up from 40.3 million ounces the year before. Sit with that for a second. This isn't a one-year anomaly caused by some temporary disruption. It's the sixth year in a row that the world has consumed more silver than it has mined and recycled combined. And the way that gap gets filled, year after year, is by drawing down above-ground stockpiles that were built up over decades. Since 2021, the Silver Institute estimates that roughly 762 million ounces have been pulled from those reserves, just to keep the market balanced. That's an extraordinary amount of metal to have quietly disappeared from vaults over a 5-year stretch, and it happened almost entirely outside the headlines that dominate daily price coverage. If you want to see where that pressure is actually showing up, look at COMEX registered inventories, the pool of silver sitting in exchange-approved vaults that's specifically available to satisfy futures contract deliveries. Those registered stocks have fallen by roughly 75% since 2020, from somewhere around 346 million ounces down to approximately 88 million ounces as of earlier this year. That's the metal standing behind the paper contracts that set the price you see quoted every day. When that buffer keeps shrinking, while trading volume in the futures market keeps growing, you end up with a widening gap between the price discovered on paper and the physical reality of how much metal is actually accessible for delivery. Historically, gaps like that don't resolve quietly. They tend to close in sudden, sharp moves once enough market participants start asking for actual metal instead of paper claims on metal. Layered on top of that shrinking exchange inventory is something happening at the retail level that doesn't get nearly enough attention. Physical coin and bar demand is forecast to climb meaningfully in 2026, with a notable rebound in buying out of the United States specifically, even as high prices have pushed some jewelry and industrial fabricators to cut back on how much silver they use per unit. That's an unusual split. The buyers who are price-sensitive, jewelry makers, some electronics manufacturers, are pulling back exactly the way basic economics would predict. But the buyers who want to actually hold the metal itself are stepping in at a faster pace, not a slower one, even after a year that already saw prices multiply several times over. When the price-sensitive side of a market is shrinking its usage, while the physical ownership side is expanding its appetite at the same time, that's not a market behaving like a typical industrial commodity. It's a market where a growing share of participants are treating silver less like a raw material and more like a form of savings. Gold's version of this same dynamic is playing out at the sovereign level rather than the retail level. Central banks around the world, led by buyers like the People's Bank of China, have continued accumulating gold reserves at a pace roughly double what they were buying in the decade before 2022, according to World Gold Council survey data, with a large majority of central bank respondents expecting their own institutions to keep adding to reserves over the next 12 months. These are not traders reacting to a jobs report or a speech in Sintra. They're long-horizon, price-insensitive buyers making multi-year decisions about how much of their reserves should sit in dollars versus how much should sit in physical bullion. And that decision-making process runs on an entirely different clock than anything we've discussed about the Fed's next meeting. This is a good moment to pause and say something directly, because I think it matters. If this kind of analysis is genuinely useful to you, if it's helping you think more clearly about a market that gets buried in noise from every direction, the most useful thing you can do is hit subscribe. I'm not asking because the algorithm needs it, although it does. I'm asking because this channel exists to walk through exactly this kind of layered story. The fast-moving headline next to the slow-moving structural truth underneath it. And if that's valuable to you, subscribing means you don't miss the next piece of this puzzle when it develops. Alright, let's keep going because there's more underneath this story that deserves your attention. One of the clearest ways to see how the market is pricing silver relative to gold is through what's called the gold-to-silver ratio, which simply measures how many ounces of silver it takes to buy 1 ounce of gold. As of the most recent reading, that ratio sits somewhere in the high 60s, close to 69 to 1. For context, the 50-year historical average for this ratio sits closer to the mid-60s, so today's level isn't wildly out of line with history on its own. But the more revealing comparison is how far this ratio has swung over just the past 6 months. Back in late January, when silver touched its all-time high near $121.58 an ounce, the ratio had compressed all the way down to around 50, a level not seen in well over a decade, reflecting just how aggressively silver was outperforming gold at that moment. Then, as the Iran conflict escalated through the spring and panic-driven gold buying accelerated while silver got hit harder by fears of an industrial demand slowdown, that ratio stretched out dramatically in the other direction, at points pushing past 80. Watching a ratio swing that violently in less than 6 months tells you this is a market where sentiment is doing at least as much work as fundamentals in the short run. And it's worth remembering that every time this ratio has stretched into the high 70s or 80s in past decades, the eventual normalization has more often come from silver catching up to gold, rather than gold falling to meet silver. Now let's connect this back to the artificial intelligence conversation, because Warsh's comments in Sintra about AI weren't just an offhand remark. They connect directly to why silver's industrial demand base has become so different from what it looked like a decade ago. About 60% of all silver demand today comes from industrial applications rather than jewelry, coins, or investment products, and a meaningful and growing share of that industrial demand is now tied to technology infrastructure that has almost nothing to do with interest rates. Every advanced semiconductor package, every piece of electrical switching equipment inside a data center, every solar installation feeding power into an AI compute cluster requires silver because of its unmatched electrical conductivity. Cleveland Fed President Beth Hammack, speaking at the same Sintra Forum, specifically pointed to hyperscale technology companies as buyers willing to pay almost any price for the physical inputs that go into AI infrastructure builds. That comment was framed in the coverage as a warning about inflation, and it may well be exactly that from a macro perspective. But from a silver market perspective, it describes something else entirely. A class of buyer that isn't going to slow its purchasing because the Fed hiked or held rates in September. That's about as close to demand that doesn't care what the Fed does as you'll find anywhere in the commodities world right now. And it sits on top of, not instead of, the structural mining deficit we just walked through. What happened next completely reframes how you should think about the risk side of this trade, so let's be honest about it. Because a story like this only has value if it's balanced. The most immediate geopolitical variable still hanging over this entire market is the situation in the Strait of Hormuz. Shipping through that corridor, which under normal conditions carries somewhere close to a fifth of all the world's seaborne oil, has been gradually recovering following a ceasefire framework between the United States and Iran, and oil prices have fallen substantially from their wartime peak as a result. That decline in oil prices has been one of the quieter forces helping ease inflation expectations, which in turn supported Warsh's softer tone in Sintra. But shipping analysts and commodity strategists have been consistently clear that this recovery remains partial and fragile. Iran continues to assert some degree of operational control over vessel traffic through the strait. Insurance costs for tankers moving through the region remain elevated compared with pre-conflict levels, and any renewed escalation, even a limited one, has repeatedly shown the ability to send oil prices sharply higher within a single trading session. If oil prices were to spike again, the inflation easing narrative that's currently supporting gold and silver could reverse quickly, and that's a genuine risk that deserves your attention rather than dismissal. There's a second risk worth naming plainly as well. Thursday's soft jobs number was one data point, not a trend confirmed over multiple months. If July's jobs report, due out in early August, comes in materially stronger, or if an upcoming inflation reading surprises to the upside, the market could just as easily snap back toward pricing in a September hike, and both metals would likely give back some or all of this week's gains. The $4,000 level on gold has become something of a psychological floor in recent weeks, one that traders are watching closely, and how that level holds up under renewed hawkish pressure would tell you a great deal about how much of this market's support is coming from short-term positioning versus the deeper structural forces we've spent the past several minutes walking through. It's also worth being honest about the limits of the structural deficit argument itself, because no trend runs in a straight line forever. Elevated prices have already started pushing some solar panel manufacturers and other industrial users toward what's known as thrifting, finding ways to use less silver per unit of output, or substituting other conductive materials where the engineering allows it. If prices continue climbing, that thrifting trend could accelerate faster than current forecasts assume, gradually narrowing the very deficit that's supporting the structural case. None of that erases 6 years of accumulated drawdowns, but it's a reminder that even genuinely structural stories have feedback loops, and high enough prices eventually start solving part of the problem that created them in the first place. So where does that leave the case for silver specifically, sitting where prices are today? A wide range of institutional research desks have weighed in on where gold and silver could be headed through the rest of this year, and it's worth walking through that range honestly rather than cherry-picking the most bullish number. On gold, JP Morgan has maintained a fourth quarter 2026 target near $6,000 an ounce, while also flagging a bear case floor closer to $4,340 if conditions deteriorate. Goldman Sachs, by contrast, trimmed its own year-end target down from $5,400 to $4,900 in June, citing softer near-term investor flows, even while maintaining that the medium-term structural case, driven heavily by central bank buying, remains intact. Bank of America has pointed to a 12-month target around $6,000, with its analysts specifically citing Fed leadership uncertainty and long-term fiscal deficits as underappreciated risks to the upside. On silver, the spread between institutional forecast is even wider than it is for gold, which tells you just how much genuine uncertainty exists in this specific corner of the market. JP Morgan's research has pointed to a full-year average somewhere near $81 an ounce. Goldman Sachs has discussed a range between $85 and $100, and Citigroup has floated a second-half target as high as $110, citing acute physical tightness. On the more cautious end, Bank of America's analysis has suggested a 2026 peak closer to $65, with a full-year average nearer $56. None of these are guarantees, and every one of these institutions has revised its own numbers multiple times already this year as conditions shifted. What the spread itself tells you is that even the most sophisticated research desks in the world are genuinely uncertain about the pace of this market, even as most of them remain directionally constructive on where it's headed over time. Given everything we've walked through, here's a practical way to think about what to watch over the coming weeks. Because this is a market that rewards people who pay attention to the right signals rather than reacting to every single headline. Keep an eye on how gold behaves around that $4,000 level and how silver behaves relative to the $58 to $60 zone, because sustained moves through those levels on strong volume would suggest the market is treating this as more than a short-term bounce. Watch the CME FedWatch Tools pricing for the July 28th and 29th FOMC meeting and the following September meeting, since that pricing will shift with every economic release between now and then, and it's currently one of the more reliable real-time gauges of how the monetary layer of this story is evolving. Keep half an eye on headlines out of the Strait of Hormuz specifically, since that region has repeatedly demonstrated its ability to move oil prices, and by extension inflation expectations, within hours. And separately from all of that daily noise, it's worth periodically checking in on COMEX registered silver inventory data and the Silver Institute's ongoing deficit figures, because that slower structural story doesn't resolve on any single day, but it also doesn't reverse itself easily once it's been running for 6 consecutive years. One more thing worth watching, and it's easy to overlook because it doesn't generate the same kind of headline as a jobs report or a Fed speech. Keep an eye on how silver premiums behave in physical markets outside the United States, particularly in places like Shanghai, where local buyers have at times paid noticeably more than the COMEX quoted price to secure physical delivery. When those regional premiums widen, it's usually a sign that physical tightness is showing up in the real world before it fully shows up in the futures price you see quoted on a screen. It's a slower signal, and it won't move in a single session the way a jobs number does, but over a period of weeks or months, it tends to be one of the more honest indicators this market offers. Let's bring this all together, because there are really 2 lessons sitting inside everything we've covered today. The first lesson is that headlines and underlying substance are often 2 different things, and the gap between them is usually where the most useful information is hiding. Warsh's Sintra appearance was reported almost everywhere as more hawkish confirmation, when the more careful read reveals a chairman who left himself genuine room to maneuver, and who, alongside 3 of the world's other most powerful central bankers, has moved away from a communication style that dominated the last 15 years of monetary policy. The second lesson is that markets like silver are being shaped by 2 forces moving at completely different speeds: a fast monetary layer that reacts within minutes to a jobs report or a central banker's word choice, and a slow structural layer built from 6 straight years of supply deficits and a shrinking pool of deliverable metal, a layer that doesn't care what happens at the next FOMC meeting. Neither of those stories cancels the other one out. They're both true at the same time, and understanding how they interact is a far more useful skill than trying to guess which direction next week's headline is going to push prices. So here's the question I want to leave you with. Given everything we've walked through today, the fast-moving rate story and the slow-moving supply story running underneath it, which one do you think is going to matter more over the next 6 months? Drop your take in the comments, tell me which side of this you find more persuasive, and if you disagree with anything in this analysis, I genuinely want to hear the pushback, because that's how this conversation gets sharper for everyone watching. Thank you for spending this time working through the data with me, and remember, this is for education and discussion only, not personal financial advice. I'm sharing a way to think through the history, the market, and the ownership questions so you can make your own decisions with your own money and your own risk in.